This is episode 286 of the Andrew Hines Real Estate Investing Podcast. Welcome back to the show. Today I have Nic DeAngelo on from Southern California. Nic is an absolute wealth of knowledge. He reached out to me, a member of his team reached out to me on one of my emails, and I read up enough about the guy, thought he sounded interesting, and decided to have him on. And yeah, he didn't disappoint. We got heavy into the economics, the differences between Canada and the US. We talked about getting started, getting your foot in the door if you're new and you want to learn, and you have the ability to, take less pay or take no pay to get experience, what a difference that can make for your life. And Nic was a guy that grinded it out in his younger years. He got a foot in the door by making a guy who ran a multi-generational family real estate investing company an offer he couldn't refuse. The guy said, he asked him, "Can I work for you for free?" And the guy said, "No, because that will cost me money because I'll have to train you." And he's like, "Well, what can I do? Find something that makes me money." And it was an interesting story. Nic explained how he did that. And then we got all into economic projections and work ethic, all that stuff, and what we see as an outlook for North America going forward. So I'm confident you're going to get a lot of good gold nuggets out of this. It was refreshing for me. I thought it was a different episode, and I'm going to keep doing this where I'm just trying to get slightly different takes and slightly different approaches with these episodes, go down different paths than we might normally to keep it fresh, interesting, new, all the above. So with that in mind, I just want to encourage you, if you are new to the podcast, on YouTube, you can actually go all the way back to like episode 1, and you can work through those first 10 episodes, which are very foundational if you want to just get a basis for real estate investing knowledge. And then you can come right back on up to modern episodes. You can also check out my cash flow sheet for analyzing deals. Play with that. I can always tell when I'm talking to somebody who's run the numbers and understands their numbers, and I can always tell when I'm not. Definitely play with that sheet if you haven't already. It's andrew-hines.com, and there'll be a button there you can click and opt in to grab a copy of that. So without further ado, let's go ahead and jump into the episode with Nic DeAngelo. Please enjoy. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I've got Nic DeAngelo on from Southern California. I always get interesting guests from Southern California, so I'm looking forward to this. Nic, thanks for doing this.
Andrew, great to be here, man. Great catching up with you beforehand. Love your guys' show, and I'm excited to jump in today.
Yeah, well, you were mentioned to me off camera there that you've played some hockey in your life, and so you've never been to Canada, though.
No, I haven't. I have not been to Canada. I've never played hockey in Canada, but like I was saying before, shoot, I want to lace up against some Canucks and see the style up there, So one of these days I got to get up to Canada and maybe play some pickup hockey.
Yeah, if you like winter, I would say just come for the hockey and the skiing maybe, and then leave. I like the warmth. I'd take Southern California, so that's awesome. Nic, could you give me a little bit of a background on yourself, how you came to be a real estate investor and the nature of the work you do, and give me a bit of the backstory?
Absolutely. So my background is biting off, really trying to jump ahead and bite off more than I could chew very early on, right? I wanted to get as close to the biggest operators and the biggest deals as I could, as early as I could in my career. So I was blessed to be raised around some amazing entrepreneurs and some amazing business people that had great ideas that were bigger than what I saw around me in a lot of places. So my goal was to be close to, let's say, family offices. So I jumped in immediately. I graduated college in the midst of the Great Recession and basically had to barter to work for free for a family office. Became very close with the head of the family office, kind of the patriarch of his family. Ended up working with 2 different family offices along my early career. And early on, everybody was holding on for dear life. So I went into acquisitions because it was the only way that I could add value was to make them money. So I still believe that the highest and best use of real estate is leaning, especially if you're starting out, I should say, is leaning into the acquisition side and understanding where the dollars and cents are in deals and in markets. And so I did that. That's where I made my bones, was on the acquisition side. And then we woke up one day and had more properties than, those owners, those landlords knew what to do with. So I started Saint Investment Group as an asset manager of those assets. And we've been raising money ever since and seeing how big we could grow with our amazing investor base.
Okay, so when you say family office, so you're just saying like a wealthy family that had a big portfolio, you worked for them, tried to learn the ropes?
Correct. These were not New York City, Manhattan family offices with, a 50 billion under management situation. These were multi-generational real estate families that were, let's say, 9 figures, right? Okay. So maybe on the low end, 100, maybe on the high end, the higher end was probably like 350 million as far as the family. But I got to see a few things: multi-generational investing strategies, multi-generational tax strategies, and multi-generational business ownership, all of which were very interesting. And I learned a lot about what I would do and what I would do in that position. And so we apply a lot of that today.
Yeah, that's a classic example of not inventing the wheel. Like, why, so many people could go out there and do it on their own. Like, I would do exactly that if I had, like, if I were in your circumstances, like you're describing. If I had only had that wisdom, I graduated around the same time you did, right into that economy, and obviously that was a harder time. But that's brilliant that you just did that. Like, if you have the ability to, say, live with your family or house hack or do something and just keep your expenses really low and then go learn it, like, you basically become the master.
Well, so I looked at it, and I still look at most of what we do as a risk reward basis. So I was dead broke. So there was no going lower than dead broke, right? Like, it was almost poverty level, like dead broke. So if I'm already there and there's no real handsome jobs in the market anyway, so they're paying very little anyway, and so I'm already going to be scraping by. Why would I not scrape by with the biggest possible company with the biggest possible opportunity I could? That's how I viewed it at that time. I was like, life is going to suck for a few years no matter what. I'm going to be real broke for a while. Let's get it close to the biggest deals and the biggest money as that I could, and learn what I can from those guys, because they seem to be doing something that's working for 2-3 generations. So I just looked at it as the risk was very low. I was already didn't have a lot of money, and the reward was very high, sticking close to people that had generational talent and mindset. I also was always interested in this space, so this wasn't like a square peg round hole thing. I've been reading books on this, on investing. I'd always tried to be around the investment space. When I went to school in LA, I was always going to investment groups, even as an ultra newbie, talking to people, networking, trying to learn as much as I could. So when it came time, there was no risk. There's really no risk for a young, kid in his 20s who's already broke. You can't go down anymore. So I just wanted to see what the highest level could look like. And that was a good bet. I'm happy I made that bet at that time, even though I could never have that full perspective at that time.
Yeah, and that's just the thing, right? Like, I can hear you say that, and I wish I had the foresight, like, back then. But before I had kids, before I was in a serious relationship, it's like, it doesn't matter how crappily I live. Like, I could live under a staircase and just use it as an opportunity to learn. And that would have been, because for me, I would get excited about the idea of doing things different than my parents, because my parents, like, my dad was a school teacher. My mom was like a sort of part-time entrepreneur, made a little bit of money, but never really. Like, more of the tax write-offs were the advantage. And they kind of struggled with money. So the idea that I could just go, okay, we'll just work for free for a few years and then learn everything there is to know. And of course, you're never going to know everything there is to know, but learn, like, what you think you can take from that one and then move on to the next. And sooner or later, somebody's going to pay you. And you could even make that offer. Hey, if you like me after 3 months, you start paying me. Like that alone, I think a lot of people would say yes. Is that how you pitched it?
Yeah, I mean, on my side, I couldn't even get in the door, Andrew. If you want me to be dead honest, and you want me to have like a moment of, being a little bit, open the kimono a little bit, being an open book, I couldn't get in the door. I took this guy to lunch. He was a friend of a family member, and I just said, hey, I know what you're doing. I appreciate you just giving advice, first and foremost. I'm just appreciative you're here. But I have a deal for you. I'll work for you for free, just a free employee, right? I thought that was enough. Mm-hmm. I thought I was giving him like this smoking deal. And he leaned over, he kind of chuckled a little bit, but like respectfully, he wasn't being a jerk. And he leaned over and said, free, I can't afford you, right? You're overpaid. And I was like, it was like getting slapped in the face, right? And I go, well, what do you mean? Free is free? And he goes, no, free is not free. Okay, I'm running a company in the middle of the greatest recessionary period since the Great Depression. We're holding on for dear life. I'm letting go of staff left and right. I don't have time for a free employee that doesn't know anything, that I have to train. That's basically just like kind of like a weight, like a dead weight, right? And I was like, oh man, I'm like heartbroken. I'm like hurt, by that. So, and I just said, well, okay, that's fine. I don't want to push anything, but if I was going to work for you, how would I get in the door? And he said, make me money. Find a way to make me money. And I was like, that's fair. So what I did, Andrew, like I said, I was going to these investment groups. I leaned into marketing, because marketing at a high level you can do for low cost if you're really strategic at it. And I rounded up lists of all these different investors that were interested in opportunities to invest. I didn't have any opportunities. I didn't even know where to find opportunities at that time. But I just said, hey, if I could find opportunities for below market, do you have the money to invest? And I consistently found a small circle of doctors and I think dentists at that time that still were making good money, put together a list of 500 that were actively saying, hey, I actively want to buy deals right now. I understand this is a good time. So I went back to the guy that shut the door in my face and, hey, can I get this job? I have an offer for you. Here's 500 people that want to buy real estate in this market, in the worst market we've had since the Great Depression. So with that said, your brokerage guys still need to eat, which will pay you, right? So if you're doing deals and you're transacting, you will still make money. Somebody on these 500 people are going to do a deal. Just put me in, coach. Let me just have a desk. I'll stay out of the way. I won't try and, put a burden on you, and put me wherever you need more horsepower towards making money, and I'll figure it out. That was my entire strategy, was just get me close. I'll figure it out. So that list got me in the door, and he made money off that list. And so that basically paid for my zero salary to get me in the door in my time. And then I leaned into acquisitions because he's like, look, I don't need operations help. I actually need a thinner team for operations. We got too many problems. But if you're finding good deals and good opportunities that are below market, he's like, hey, I'll find the money. So that's where I got my big start, and that's where I leaned into from there on out. But even getting in the door was a nightmare in like the 2008, 9, 10 era. Mm-hmm. The market didn't exist in a robust way. Even today with downturns that we're dealing with, it's not 2008. We know that. You know what I mean?
Yeah, it doesn't seem to be. And that's another topic we should definitely dive into. But yeah, like what you're describing, these are a lot of the things I thought, because I've hosted this podcast for over 5 years, and I've had people reach out to me saying, I'll work for you, Andrew, I'll work for you for free, because I said this is a great way of doing it. And then they pitch it to me, and I'm like, I thought the same thing. Like, I can't afford to take the time to teach you how to do something even for free, because that actually costs me. That costs me my time.
Big.
Yeah, like they need to come in with a solution. So I think it's for people who are trying to figure this out, because I think there is no better way than going and working for somebody who's done it. But you have to first study them from afar and figure out how to help them first, and come into them with I can help you, and here's how I can help you. And all I ask for in exchange is don't pay me, but let me work for you.
But that's a different trend than the discussion going on in the economy at the lower level of jobs right now, the entry level jobs. The discussion is exploitation of labor, or the discussion is paying a living wage. And I think all those things are very good things that we should be always analyzing as countries, right? Mm-hmm. But the reality is, I've never been more exploited than when I was begging to be exploited. Does that make sense? I wanted to work for free because I knew the net value over time was more than this guy could ever pay me. I didn't want to take any money. Yeah,
you could do a time value of money calculation on that, and you'd know it's worth it, right? If you figure, hey, with the knowledge I'll get here, in 5 years I'll be making $500,000 or something like that. You run those numbers all day long, it makes sense to work for free. It's just it's being intelligent enough to think about that. And you know what? I don't think I ever thought about it that way when I was younger. I didn't. I wish I had. I knew I wanted to do things differently, but just didn't know. So that's it's great. I hope people who are young who are listening to this podcast can take something from that, because it would just change your life. Do it before you have the family. Just do it all.
It's hard with kids. You know that.
It is. Yeah, with kids, like Yeah, I mean, my wife pretty much like asks me to come to bed by like 9:30, like because I'll disrupt her when I come into the bed. Otherwise, so it's like, when do I work? Is it? I get between 9 and 5, basically, at best.
So you got to
So,
make the most of that.
got to
right?
make the most of it. Can't waste any time. Have to be very, very deliberate about what I do. And do you have kids as well?
I do. I have 3 sons. So I have to be the biggest cowboy in my house constantly. There's a lot of craziness. My partner, the love of my life, she is the best mother in the world. And very blessed to have her in the midst of all that chaos also. And I work a lot of hours. I'm positive you do too. So the work-life balance doesn't exist. It's either a lot of work or a lot of balance. You know what I mean? It's like a lot of time with the family. I took a couple days off for our 4th of July in the U.S. and I'm working hard during the week. A lot of hours. Sometimes it's very late, but that's hard to find the balance when you're running your own business and running the real estate side.
Yeah, especially when you're in like growth phase. It's you have a million people who want your time, and you have to delegate so well. And how do you find that working for you? What things do you delegate? What don't you delegate? Give me the high level of sort of your operations and when you get involved and how.
So this is a core question. Like I'm passionate only about a few things in this entire world, right? I like economics. I like some health stuff. I have some, minor hobbies on the side that I can do on the side, but I'm super passionate about investing in entrepreneurship, investing in business ownership. Those are 2 things that are lifelong passions. So I'll tell you early on, kind of like you said, the growth phase, my growth phase of like my net worth, I knew that I needed to climb the ladder very rapidly to get to a certain level where my net worth could start growing on its own a little bit more and leaning into itself and getting its own snowball trajectory. So for me, that was trading in most of my 20s. Just to be clear, like there's no sugarcoating the fact that I worked the majority of my 20s, 80, 90, even 100-hour weeks, ridiculous schedules, right? And the goal was to build businesses and to build, machines for investing along the way that could pay me over time, and get more return out of it than I put in eventually. Up front, your return's zero. It's all effort. It's no return. That's what business, that's entrepreneurship at its core. So how I balanced that early on was I just leaned into it absolutely completely. I was working, hours that didn't allow for hobbies. It didn't allow for close relationships with friends and family. It didn't allow for health, right? So all those things failed. My health, I had a big scare, one big scare in particular. Relationships completely fell off. The last thing was my romantic relationship, and that was on the rocks. That eventually ended too. Everything hit at one point, and I reached a point where I was making a lot of money, right? We had some businesses that were very successful that we built over time, and I analyzed my time. And I did one thing that I was very blessed to lean into and have the foresight of, and it was because of my experiences with the family offices. Every dollar that came in, I put the majority of my net towards real estate. Constantly, every single month. One, I needed the tax break, right? I needed the tax benefits. And 2, I knew that, different business cycles, we were in a business cycle and I was having a killer run, but I didn't know how long that would go. So I needed to take chips off the table. And what I woke up realizing was that a huge disproportionate amount of my income, let's say between 80 and 90% of my regular monthly income, was now coming from real estate, even though about like 10% of my time was, right? It was so disproportionate in kind of like my mid-late 20s when I had these businesses that it was a slap in the face where I needed to sell those. If I was going to be true to the numbers, which you always need to be in your business, and you have to be accountable to yourself, then the numbers were screaming at me in the face that I needed to sell these businesses and focus on the real estate. So that's what we did. Simply put, we sold the businesses, we leaned into real estate, and I leaned into mostly on the fixed income side because that's where our investors were constantly saying, hey, the market's turbulent right now. We want something that is going to pay us a fixed amount that's going to beat the market that has underlying assets. Those big 3. So that's really why we put together our income fund, which was kind of our focus, our flagship today. But that's what I'm looking for, is to give myself what you're talking about, is force my work-life balance, right? Is to have a high enough net worth and cash in hand that I could put that toward an investment that pays 12, maybe 14% on the high end annually. And I cannot worry about it. I don't have to do all the work associated with it. So I'd say that there's a huge part that's grit up front. And once you've passed that grit and you have enough cash in hand, it's strategy after that.
Right.
So to me, work-life balance today is just being way smarter about where I place my energy and my money, because the leverage points are higher if you have more zeros, which, today we're blessed to have a lot more zeros than when we started.
Yeah, very, very well said. I think one of the things that also changes over that time is your skill, like your ability to do deals. So yes, you can be more selective. Your discernment is better. You'll naturally pick investments that do better, but your active endeavors will yield better too. They should anyway.
That's a smart perspective, because when you have no idea or no experience, how many false starts do you have? How many lefts and how many zigs instead of zags, right? Whereas when you've done it, you kind of been there, you've been in the ring a few times, you know what to see, or when you see something, how that's going to play out with a high likelihood.
Yeah.
So your efficiencies are so much higher. I think you're dead on with that.
Yeah, knowledge sort of becomes a form of wealth as long as you can implement it. Obviously it's been a challenging time, here in Canada ever since this downturn as well. I sold off a bunch of stuff, so obviously it took quite the tax hit, because I decided I wanted to invest in the US. So I started just liquidating here and putting money down south. So we do a bunch of stuff in Florida. And I think it's just a great place to do business. But in all of that, obviously there's a cost to all that. But I feel at this point, between the network, the experience, 5 years of doing this podcast, plus like 12 of being an investor, it's like you combine all that knowledge, and like I've never felt wealthier in that regard, because now it's like, who do I know who I could call? Who could solve this problem? And then also I have the perspective of the things I've been through, which is the great part about when you get a little further along in this business, especially depending on the decisions you make. Like you said, you spent your 20s grinding. I spent my 20s mostly living with family, building up my portfolio, not owning a principal residence, deferring the comforts so that I could build up some wealth that I could build from. And that's a great lesson people could take from this.
Absolutely. I agree.
So in terms of the types of business or the type of properties you're going after, like early on, was there a type that you were going after, a certain criteria? And this was like early, like 2010 and onward. And how has that morphed and changed today?
So I'll give you my exact criteria early on, and then I'll tell you how that's changed and the painful lessons that caused the change, which is most important, that in between.
Yeah, that's great.
Early on, again, I started in acquisitions because I had to earn my keep. There was no discussion of me being on operations or asset management. That was not what it was. It was like every day I woke up starving and broke, and I needed to earn my keep with guys that were generations and massive success ahead of me. So I leaned in. The one good thing about the 2008, 2010, 2012 era, there were so many deals. There was just no freaking money, Andrew. You remember this, right?
Yeah.
There's no money. Financing was a joke. Every bank was like, skittish on everything. Nobody had any cash. And if they did, they're holding it really close to the vest. It was a tough time for money. So I found good deals, but then I found great deals. And we were looking at the most distressed assets. And I just said, I'm going to become the best distressed asset buyer that I can find in this market. So I leaned into foreclosures super heavily. I was blessed that the crowd that I was around at that time had too much money to buy houses. Literally, they're like, Nic, don't waste our time with single family houses. We can't justify spending $500,000. We need to be spending millions to make sense of the numbers and the effort and the energy on the asset management side. We have a whole team. We need to put them towards something that's sizable enough. So that was scary for me. I was a kid in my early 20s. What's that?
Was this the doctors, like the people you found in that list, or was this people that?
This was the family offices by this stage.
It was just family. It was the people they worked with. Okay, or them internally. They didn't want single family. Yeah,
mostly them internally. So when they're looking at their dollars, some of this might be family money. Some of this might be stuff that they earned. Some of this might be things that they're thinking about their children decisions about how it will impact their children. So there's a lot of considerations, a lot of responsibility on my side. But I was a kid in my early 20s with up to $10 million in my pocket in cashier's checks at the courthouse steps, which is in the US, the trustee sales. You're out there, the cash is in your pocket, right? And you're handing it to the crier, to the person that conducts the trustee sale, the foreclosure sale. So we were buying these, we were getting fantastic returns. And our only criteria at that time, which wasn't that sophisticated, and we evolved significantly since then, our only criteria was we needed a 50+% discount. Okay. Yeah. That might sound ridiculous in today's market, like ridiculous, but the reality was at that time, that wasn't that ridiculous. There was a good amount of deals that qualified. And our thought was, if it's 50% below replacement cost, how do you get burned on that over like a 5-7 year period? And that's still something that's probably a smart move, because replacement cost, how much it costs to build it, we were getting half that for the purchase price. What we learned, Andrew, was we had a few deals. So we had office, retail, mixed use, multifamily, industrial, a bunch of others in there that were subtypes of subtypes, warehouse, manufacturing, flex space, R&D. We've done all of that. Too much, really. What we learned was a few things. One was we needed to focus, because there's too many niches and there's too many nuances to each asset class. While I love multifamily with a passion, I think it's so privileged and so blessed and supported by the government. There's a lot of things I didn't like about it on the operations side as far as scalability. Also, there's fantastic operators. So we didn't have as much leverage there. What we found was the best fit was industrial in the end, for a number of reasons. So I consider us world-class industrial asset managers, buyers, operators. But at that time, we learned a painful lesson from not industrial, because we were spread across too many things. We bought an office retail building, so like a kind of mixed use deal. And what we learned was that we got the best smoking purchase price that we could possibly get on this deal, but it had one issue. We couldn't freaking lease it. Okay? Couldn't lease it. And I was like, well, office, there's always got to be businesses. There's always going to be someone that needs an office, which we're learning in today's market, again, is just not the case, right? There are alternatives to having offices. There's not really alternatives to like living somewhere. You got to live somewhere, right? But having an office, there's a million ways. You can bunk in with your cousin at their office, or you can work from home, or there's all kinds of alternatives. We couldn't lease this freaking building. And what I learned was one thing about the local economy was that you're either the local economy is either working with you, or it's stagnant, or it's working against you. It's only one of those three conditions. So if you look at Warren Buffett says, I'd rather buy I'd rather buy a good asset at a fair price than a fair asset at a good price. Mm-hmm. That really shone home for us. So what we've leaned into since then, and having this difficulty, we pulled off that deal. We ended up getting, I think, high 20s, low 30s IRR, because we brought in a government agency to lease out the majority of the building in a very long, 12-month lease negotiation. We pulled it off by the skin of our teeth. It shouldn't have worked out, but it did, just by pure grit, and we'll never do that deal again. So now we lean into the local economics, we lean into the expanded economics and the national economics extremely heavily, because we don't want to be fighting what's happening in the market anymore. So we've raised our sophistication for those reasons.
Yeah, that makes a lot of sense. And your point is very well taken. I agree with you completely on when you're doing commercial, retail, or anything like that, you're renting space, big difference, like you said, between somebody who you got to have a bed, you got to have a place to sleep, make food for your family, versus do you need office space? No. Work from home's an option. Work from your car. Like there's ways. Work from Starbucks. You're absolutely right. So that's that much more critical. Like I'm of the mindset, and you tell me if you agree with, if you're just in retail if you're in multifamily or something like that, most markets will work depending on the price you get it at. Obviously there's some that are better, but most markets can work.
Yeah, and I think the numbers, I just ran these the other day on a multifamily deal that I was just curious about. We're not multifamily operators. I think the numbers are loosely that a 3% rent increase per year over 6 years doubles investor money. something like that, right? So, with modest increases in property value, et cetera, I mean, you can take base hits in multifamily and still make good money, to be fair. So, and it's supported. It has it has great criteria for loans and supportive government financing options, et cetera. So, to your point, multifamily can work in a lot of markets. You don't have to thread the needle as much.
Yeah. So talk to me about how you're threading the needle. What areas do you like? What do you look for? Give me some of the key criteria.
So we may have overcorrected on our economic analysis, but that's a core of our business today. We literally have spreadsheets on spreadsheets on spreadsheets. We're tracking everything from CPI to PCE to PPI to jobs to inflation, of all measures and all drivers. And what we found, we take that data and we match that with what we're seeing the best investors do that we track. And so over the years, we've done syndications, we've done all kinds of different models. All of our investors were asking for something that was more fixed income, and all the drivers of the economy were going a direction where appreciation plays were a little more concerning to us with a lot of things we were looking at, because we saw a lot of syndications. And again, we've done syndications and been successful. And I think long term, there's a huge investment strategy around syndication still. I don't think that's going anywhere. But the issue is the lack of paying out of preferred returns. So on our side, as an investment group or as a capital allocator in many cases, we can't do that. That doesn't sit right with us. And instead, we saw a lot of our most sophisticated clients looking for a fixed income play. Now, if you look at the economic data on this and our drivers for what we look for, inflation's been going crazy, right? We've had inflation. Middle of 2022, inflation was 9.1% in the States. Okay, 9.1. And to the Fed's credit, after the largest, steepest, fastest rate increase in history, we're somewhere around 3, right? Let's say, I think at any point it's, low 3s, right? That they're the projections, et cetera, depending on what you're looking at, PPI, CPI, PCE, right? All that to be said, that's good progress, but it's pretty far off from what the Fed's target is of 2%. So if we're looking at the Fed even today, the Federal Reserve of the US, if we're looking at the Fed today, previous to like the last couple of days, I would have said, Andrew, the Federal Reserve has no reason to drop rates right now. Sure, it makes debt even for them more expensive. Sure, people hate it politically, economically, because it gets more expensive for buying deals and buying homes and all these other things. But the reality is the Fed's job is not to keep rates low. The job of the Federal Reserve is equilibrium, to achieve a balanced market with around 2% inflation and not a complete risk. Let me word this properly, because this is a good distinction. No depression. They're trying to have around 2% inflation with no depression. I think a recession is okay in their book. Just to be clear, I don't think they hate a minor recession or a soft landing in that case, but they're trying to avoid a depression. So go ahead.
But there will be a point, right? They're going to hit a point where they're going to have to make a decision, because I know it's a big talk. There's this one YouTuber that just talks about the level of inventory, like in Florida, for example. A lot of the builders are just sitting on a ton of inventory. You can equate, you can work the numbers based on how much sold last month, but there's like 9 months of inventory, over 200 days of inventory in Cape Coral, Florida, for instance. How long can that go on? I mean, there has to be a seller acknowledgement. Oh, prices are going to have to come down, and there's going to be those desperate situations where they're going to lower equilibrium price for 3-bed, 2-bath, and so on. So at some point, the Fed will need to acknowledge what's happening, because there's going to be a fallout from all of that. The job layoffs from the construction industry alone are going to have a pretty large impact. Do you think that that's coming? I mean, we've seen we've seen one rate decrease in Canada. Usually Canada stays right in lockstep with the US, because, if our dollar goes out of whack in terms of exchange rate, it'll screw up everything. So there's only so much Canada can do before US will make a move.
Yeah, and we have such overlapping economies, the US and Canada, in so many different ways, right? So very complementary. And Canada, people forget. I think until people look at the world GDPs, they don't understand how powerful Canada is. Canada's GDP is above Russia, Okay. And Russia is, this powerhouse. It's considered this huge, massive, powerful country. And I'm like, Canada's kicking Russia's butt on GDP alone, right? And if you look at a lot of the industries in Canada, it's much more powerful than many of some of the top economies in the world by far. So here's my bet, and here's my thoughts on it. And I'm talking mostly strictly for the U.S., which, again, there's a lot of overlap for Canada as far as, kind of paired economies in North America. You talked residential a little bit. So I have some notes on residential. I'm extremely bullish on residential for a few reasons. Now, some of that has a time horizon, but I'll kind of give you the details on that. Homes in the U.S. are one of the most interesting things compared to other markets in the world because it's about 98% of mortgages in the U.S. that are fixed rate mortgages at 30-year terms.
Oh yeah, that's great. Right?
That it's insane, right? It's ridiculous. Yeah. It's unbelievable, right?
It's the way it should be done in Canada.
I like it. It gives a lot of stability, and frankly, I don't know if that's the most efficient at points, but it gives stability unlike anything else. I have family in Italy. That ain't the Italian home market. Okay, you're not getting 30-year loans fixed, right? So not only is 98% of the market fixed rate 30-year mortgages, so that's kind of the gold standard in the US, you're also seeing, hold on, I'm sure I got a note on this. I'm positive I got a note on this. I believe, yeah, here it is. I found the note. 61% of mortgages in the US are 4% or below for rates today. So you got 3-decade mortgages. So let's say there's 2 decades left on them, right? And they're 4% or below. These people are locked in. They are stuck in their homes because the mortgage rates just in the last 2.5 years have gone up over 100%. Yep. Okay. Between property values, which I think the last number is 44% since the year 2020, 44% increase in the property value since 2020. And mortgages, so not only did the property value increase, but the rate significantly increased. So if you take that entire increase into account, mortgage payments have over doubled for Americans trying to buy homes right now. So those though their homes already at the 61% that are at 4% or lower, most of those people aren't moving for 20 years. So that gives such a powerful locked in, rock solid market that you don't see most places in the world or even in the US.
Yeah. And I've said almost the same thing on this podcast before. Like, I think the US has just had such an advantage for limiting the blow, so to speak, from this, whereas Canada could see a more aggressive decline in values. It already has seen a significant one to date, depending on the area. And it could see a lot more because in Canada, over a 5-year horizon, we're about halfway through it, all mortgages will be at market rate. So, we'll have 5% be the average rate. Can you imagine, if there's not a correction, what will happen there? And here's the wild card. Canada, over the last 2 years, has basically brought in 1 million immigrants. Canada's population, like 40 million now. So that's a disgusting level of immigration, unsustainable, unreasonable. But they're buying up all the houses, right? Everybody needs a place to live. There's just not enough houses, can't produce enough houses. So that's artificially propping the value up. So that's the offsetting factor. US, I don't think, has nearly the immigration, although you have a lot of the illegal immigration, but I don't think they're buying the houses. But they are offsetting some living situations for sure. So there may be... the way I see it is neither market becomes predictable based on the factors that are at play. You can't really tell where it lands unless, in Canada, if people stop immigrating, we know where it's going. And in the US, it's not like it's going to just fall off a cliff. But what could happen is some people who have to move make a decision, they drop their price, and slowly we do see equilibrium price fall. And that's what I would think. It would just be a more gradual decline. And then hopefully in that time frame, the market can pick back up and sort of level it off. And who knows? Maybe it just stagnates for a bit. I couldn't say for sure. No one can, obviously.
That's interesting. That's very interesting. So in the US last year, immigration was around 9 million. I think it was a little north. And then there's shadow migration data. but it's a bigger country, right? We're talking different scales.
Yeah, it's percentage of the population, right? What does that work out to
exactly.
be? 9 million. So you're seeing at a pretty aggressive level of immigration too then.
We're seeing the highest level of immigration in quite some time.
And
that's about legal. The country of, I think, I don't know. I'm not positive. I think that's about the country of Nicaragua's entire population count.
So,
right?
so that's
we're
3% for you
ingesting
then.
Entire populations.
So that's 3% for you then. 3%. If you're 9 million on 300 million, if you're approximately 300 million, I think you're more than that now. But so if Canada's 1 over 40, let's see here, 1 over 40, we're less than that? No way. So we're 2.5%, you're 3%? Well, then I stand corrected.
Striking distance, right? But so here's what's interesting is I think, and I'm not positive on Canadian immigration today. My understanding is that Canada's policy immigration wise, because you guys have many social systems that are a little different than the US. My understanding is that Canada's immigration was a very high bar. And there's like, if you're a doctor, you're fast tracked, or you have a PhD, you're fast tracked. Is that still the case in Canada as far as how you
gotta have money. You gotta have money, but it's way easier to become my observation, because I'm looking at getting a visa to be able to come to the States, and it's pretty tough. But I mean, way easier if I were to just cross the fence at the southern border. But if I want to make it official,
it's the same day.
Yeah, I got
have a drink in Tijuana. Come on up, man. I'll meet you in Southern Cal. I'll meet you in San Diego. That's not far from me.
Yeah. So it is tough. Yeah. So even for like investor visas, there's a lot of hoops we have to jump through, but that would basically give me the ability to be down there full time, and it renews every 2 to 5 years. Some people get them for 10, but that's not a path to a green card, not a path to citizenship. So it's a lot tougher. So bar for Canada, I don't know the exact requirements, but it's definitely it's seeming just from my observation that they're pretty door wide open right now. But that's going to change a little bit.
So here's something interesting that I'm seeing that's been very interesting that overlaps with the that overlaps with the immigration side. So in the US, there was this huge discussion on the real estate side because it had impacts in the office space, et cetera, on working from home, right? So I'm positive Canada has that as well. In the US, the number at its peak, so I think it was early 2021-ish, our peak in the US was 37% of jobs were work from home. Right. When I saw that, I said, that's great. We're readjusting what those structures look like in the US. But I had also like kind of a fear of that. Right. Because the reality is there's no work from home. Right. There's no work from home within a country. If someone works from home, they are competing not against their fellow citizens, but against the whole world. Right. So you can work from home anywhere. That means China. That means the Philippines. That means South America. So I mean, Andrew, you work in Florida as your home market, and you're in Canada, right? And you're kicking butt.
Mm-hmm.
You know what I mean? So you look at the U.S., our work from home rate has dropped from 37 to about 25%. But pre-pandemic, it was only like 7-8% of households worked from home. So my question and my thought on that, because I have my own thoughts and my own projections on what I think will happen there. But what do you see as like, the difference between the U.S. and the Canadian markets as far as work from home, with immigration, with, the working together of the U.S. and Canada? I mean, what are your thoughts on that as far as what you see in your business?
Well, work from home, I think it's acted the same. Like, you've seen the same thing happen on both sides of the border. Employers want their employees in the office. So it didn't fully go back to pre 2020 where you were expected to be in the office. There's way more work from home now, but it's done a similar thing. And I don't know the exact stats, but definitely a lot of people have had to go back to work. Some have negotiated and stayed remote. So,
sure.
There's some level of, you got to go into the office a couple of days a week or once every other week, depending on how much your employer likes you and how valuable you are to the team, and your negotiation skills. So yeah, it's happening. What will that do, in the grand scheme of things? Like, you need your physical workers in certain jobs, and what Canada's lacking, and which I know US, got the same challenge, is you have to bring in immigrants to basically do the physical labor, because the people who are multi-gen, they don't want to do it. They were used to the bigger checks, and they don't think that pays enough. And that's why you have a lot of, Mexican people, doing certain jobs, because that's the job they can get with not speaking English sometimes, and or not great English. And same thing here, So I think that Canada and the US are probably both experiencing the same problem at the same time, which is just a lack of people who actually want to work, and immigrants coming in and taking jobs. The work from home thing, yeah, that's here to stay. But I don't know if I answered your question.
Well, you hit the nail on the head with a few pieces of it. The first is that immigration's here to stay to a big degree. In the US, we don't have a sustainable demographic. We don't have enough people to keep the same amount of people even. So the general break-even number for a household is 2.1 children, right?
Yeah, same here.
So so I'm sure it's the same, So then that said, we're below that in the US, and that number has even ticked down with affordability questions and how much people can pay their rent. And, most people are reporting groceries are somewhere around 35% increase in the US. A lot of estimates are closer to 100% in many metros in the US, which seems to be more accurate for more people. But all that to be said is children are more expensive than they were before because life's more expensive.
Yeah.
So if all that's the case, then immigration in the US is something that it's become such a political issue in the US. It's like right versus left. If you're anti-immigration, then you're racist and a bigot. And if you're pro-immigration, then or if you're pro-limiting immigration and you want some kinds of controls on it, then you're also a racist and a bigot. So it's been this gridlock of nobody getting anything done because it's such a touchy issue that instead we just lowered our borders. We just said, hey, come on over, right? So the reality is in the US, we have to figure out what this balance is. We need the immigration. We need the immigration to continue to grow as a country, but nobody's willing on either side of the aisle to step up and take leadership on it because it's so easy to pull a racist or bigot card in the US, and that's such a hot button right now. So,
that's it's just so inefficient, that whole the ad hominem attack for just pointing out things that are logical. The thing I pointed out, which I mean obviously could be taken out of context, is there's a time it takes for somebody to come in and assimilate into a culture. And if you come from your own country with your own culture and you come in mass volume with your entire country to one country, you don't assimilate into the existing culture. You create a pocket of your own. Right. And that's why we have Chinatown, Little Italy, all that stuff. Like this has been going on for forever. And the challenge is when the cultures don't have common values. Diversity is strengthened as a diversity of skills, diversity of backgrounds for application. But diversity in morality is something that actually just creates lower trust societies. So this is where the immigration challenge comes in, because we've increased the cost of having kids, which is why people are waiting. And my wife's got multiple, friends that are, getting into their mid 30s, still thinking, yeah, we'd love to have kids one day, but want to get established in my career. I'm like, whoa, okay. I have this perspective now. I waited way too long to have kids, and I wish I'd started sooner, but it's just not going to work. And we have a choice to make. We either prioritize building family over giving our kids a better life than we had. If we don't prioritize building family first, our culture will just erode away into nothing. And that's really the decision we have to make. And a lot of people don't really ever think about it that way, I don't think. But I've spent a lot of time thinking about this, and I'm like, we have no one to be mad about but ourselves. If we didn't have at least 3 kids, look at yourself, point in the mirror, because it would work better. And then we would work our own jobs, right? We wouldn't be above those. The other thing is glorifying the white collar. Acting like blue collar and trades and manual labor were bad somehow. They're not. They're great. It's great jobs. It's not for everybody, but we need more people to pick them up. I say that sitting in a seat, talking on a podcast for work, but you know what I mean.
Yeah, and it's my background, DeAngelo. I mean, I'm Italian immigrant or Italian, immigration through the U.S. Right. So I'm Gen 2. So early on, it was very easy to keep our culture while still assimilating. My family, even my grandfather, was like, we're American. Yeah. Right? We're Italian descent, and we're very proud of that. And we really appreciate our roots, and we love our family at home back in Italy, but we're Americans.
Yeah, you embrace the American culture, right? And that's
100%.
that's
And
the
with
beautiful
pride.
thing about the
With
US,
pride.
man. People have so much pride in the country, and because they know what it stands for, freedom and opportunity. You don't get anything handed to you, but it's a place you can go to make it, and number one destination in the whole world for that. And Canada's a close second or third, in a lot of people's eyes.
time.
In perspective, in perception, in reality, I think the US is way better. And
I think the U.S. has lost a little bit of that pride, and I think
sure.
people aren't as proud to. You see people that are their native country first and American second. In my family, that was not okay. It was, we came to the U.S. because we're proud to be here. We're even proud to be part of the U.S. and to do that because we have family in other parts of the world that are struggling. I had family in Italy. I had family in the Czech Republic. Not good places to be at certain times of history, right? So to be in the U.S. was a huge sense of pride. And I think you hit the nail on the head. As generations go by, what do you want your family and your culture as a family to be determined by? And you have to make decisions along the way. You're a father, right? Mm-hmm. So you're one of the leaders in your home. You have to make decisions with your wife on what the core values you're going to teach your kids and how you guys get together and how you treat each other. And each generation needs to be more thoughtful of that. So I want my kids to live in a multi-generational family where they know their grandparents. So I need to live close to my parents, to my wife's parents, right? They need to be close with these people and their aunts and their uncles and things like that. So I think you hit the nail on the head. I wish I had kids earlier too, right? I love my kids. They're amazing. Yeah. How many kids you got, Andrew?
I got one and one on the way.
God bless, man. That's amazing.
Yeah.
So you get it. You get it.
Yeah, man. Like I said, I wish I started sooner. I'd love like 8 of them, but we'll see how far we get.
I do 8.
Anyways, Nic, what do you want people to know? We've had a great talk. I appreciate this talk. What would you like people to know before we wrap up here?
I'd say the biggest. So we spent a lot of time on the economy. I'll just share my insights, just the quick highlights of what we're seeing and what we're looking at, because that's kind of the most common question I get, especially from our investors, or what are our biggest, our highs and our lows. Mm-hmm. I think the top 3, economic forecasts that I'd give that, we're kind of seeing in whatever degree of crystal ball, we can formulate with the data that we have today. I personally see higher inflationary trends. So that'll either be higher inflation, like a bumping up of inflation, or higher interest rates for a longer period of time than is to be expected normally in normal conditions.
Right.
I see rates stabilizing around like the 5-6% range for maybe a decade plus, candidly. I think there's a lot of upward drivers. I think a lot of that will be caused by the U.S. pulling a lot of manufacturing back to the stateside after we've had our issues with China, and we've had our issues with rising costs in China and disruptions of supply chains, et cetera. I think the U.S. is realizing that there's a degree of stability that's required so that we don't have runaway inflation on our side. The next is I don't see a crash in the economy coming up. What I see is a softer landing. I think the Fed, which pre-2024, I have all kinds of criticisms of the Fed, the Federal Reserve in the U.S. I could quote Janet Yellen forever saying that inflation is transitory. We knew that was BS then. We know that's BS now. We know that was a crap statement, and none of the data showed that even at that time, right? Yeah. All that to be said, I think the Fed is being more thoughtful and thinking around the curve and thinking more about how to round the edges rather than manage a political side. And I credit them for making that shift. I think we're looking in for a soft landing and not a crash, including in real estate. The third is I believe that there's the most investment opportunity today. There's a higher opportunity for investing, especially in real estate, a higher opportunity today than anything we've seen since 2008. So those are kind of my big 3 thoughts today. I have infinite drivers and infinite numbers behind those. But if you were to ask me kind of like my highlights of like my big takeaways, that's what I'd say in the market today.
Yeah, I love it. I couldn't agree more. I think the opportunity is ripe right now, especially when you have like a lot of people, like especially in the housing market, you got a huge amount of inventory. There are going to be people ready to make deals. So my business partner and I, we run a flipping business in Florida. And we're getting like 1,000 leads. We're probably at like 1,000 leads since we started, maybe 100 to 200 leads a month. And we're just, buying land, buying houses, 50 cents on the dollar on the land, and houses will go to like 70.
Killer. That's
Yeah.
killer.
Yeah, and the opportunity's there, right? Like people could say, it's a tough time, I don't want to invest. For me, it was more like, okay, well, how can we invest in a way that we feel really comfortable? And that was what we came up with. And I think that I'm sure you have stories about how you can do that with industrial and make it work. So, yeah, we could definitely do this again, and I hope we do in the near future. I'd love to dig in more with you and kind of learn more about what you do. So tell us, where do people find you, learn more, follow you, reach you, all that?
Absolutely. So the absolute best thing that I can offer listeners is we give all this away for free. We have huge economic data and reports and write-ups and even full webinars on economic topics, 60, 90-minute webinars that dive really deep on how to invest today, what to invest in, what the strategies are, what the economics is showing us. And all that can be found at saintinvestment.com/resources. We just give it all away for free. We're already doing all the work. So we figure on our side, candidly, the more an investor is educated, the more likely they are to invest with us. So it's self-serving in a way, but it's also like we're going to give it away either way. So saintinvestment.com/resources has a ton of free information for investors.
Awesome. All right, Nic, and do you want people to follow you on Instagram or anything like that, or we'll just send them to the website?
I love connecting with investors. I love connecting with people into real estate. And my handle on Instagram is Nic DeAngelo, at NicDeAngelo.
Perfect. Yeah, I will include all that in the show notes. And I hope we can stay in touch. This was great.
Me too, Andrew. I had a lot of fun today. Let's do this again soon and talk soon, my friend.
Okay, sounds good. Thank you.